Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. Today we're talking about industrial real estate. Now we've looked at what has happened in industrial real estate. Now let's look at what we're going to see moving forward. Please welcome my guests here, Amy Olsen and Mitch Roschelle, both from PwC here in Studio One in Atlanta. Thanks for joining us.
Love being here, Michael.
We appreciate it. And we've had the pre-show hijinks. We've got that out of the way, right?
And we're periscoping.
Periscoping as well. That's right, as we speak. Let's look at the continued demand. I mean, the demand for industrial space, Amy, has been strong. It's been great. Do you expect to continue that type of demand moving forward?
Absolutely. We just finished our Emerging Trends in Real Estate 2016 report, and as you may or may not know, I think you and Mitch talked about this earlier, industrial is the #1 ranked property type looking forward for real estate prospects. So looking in at least the next 12 months, very, very strong. And from an investor perspective also, we expect to see from our PwC Real Estate Investor Survey, cap rates continuing to compress a little bit further and rental rates going up.
And that's amazing. And what's driving all this demand for space?
So a couple of things, the biggest which is retail. So it's funny that we're talking about the retail asset class on a show about industrial, but I think the two are interconnected. And what's really interesting about retail is the growth and trajectory of online retail is a hill that you probably couldn't ride your bike up. I mean, the trajectory is very high, double-digit year-over-year growth, and that stuff has to get to people, and the way from manufacturer or when it gets off a boat somewhere in a port in America, somewhere between there and your house are multiple warehouses. And where those warehouses are have changed dramatically. That's the biggest demand driver in industrial.
And are all the tenants driving demand from the very big box to the medium and the small users as well?
I'd hate to say that the answer to the question is location on a real estate show, because that just seems incredibly trite, but it's really, just think about that supply chain and think about where the stops are on the supply chain, and that's going to tell you who the tenants are and where those tenants are, because the end consumer of that online purchase, and we're right about to hit the holiday season, and all the data from work that we've done at PwC around millennial shopping, it's an online story, and how does that get to the end customer quickly? That's what's going to drive demand for industrial.
Okay, so a lot of the online sales is driven by the millennials?
There's a biggest wedge of the pie in online sales are millennials, but what's really interesting, and maybe this, now I'm switching into an office show also, is think about when millennials buy stuff online, where it gets delivered, because it's not their home. Now that's a fourth show, because we just talked about housing, but it's not their home, it's their office. Yeah. So the warehouse that the stuff is in needs to be proximate to the place where the millennials work, not necessarily the place where they live.
And then you have the industrial buildings that need to be close to these large cities, right, for that last mile?
It's for the last mile and for the traffic that, if that traffic gets in the way of that overnight delivery, that's a problem.
And one of the things I think is real interesting about the forward look that you guys do is also kind of the investor sentiment and what they think about cap rates moving forward. And so investors, they're really bullish on industrial, aren't they?
They are. If we want to put up one of the graphics, we've got National Warehouse Trends. We're showing where cap rates have gone since 2009, and you can see that they're back down to 2008 levels, interestingly, and rent growth is back up to 2008 levels. And our investors, as of our last quarterly report, looking forward, like I said, they expect some more compression in cap rates, and they do expect rents to go up a little more slowly, but still there's some movement there.
And is some of that from the lack of new construction that the new construction has been really tepid, hasn't it? Is it starting to pick back up?
It definitely is picking up, and I think there are certain markets where some of the investors are a little bit cautious, but overall it's so much more controlled than it was the last cycle that so far they're pretty positive in their outlook.
Now, you just brought up what inquiring minds want to know. What are the hot markets? Where should investors be looking, and developers, where are they interested moving forward?
Well, it's interesting. I don't know if we can put up the other
they'll be up
They'll
graphic.
be up
Yeah.
there.
Yeah, the other
Except for the
graphic.
people in their cars
The cars,
driving.
the cars.
Yeah.
You'll have to wait till you get home and hit the link.
Right. We did, in Emerging Trends, of course, you look at the top markets overall, but in our survey, we do an interesting analysis of transactions based on the amount of stock in a market. So the amount of industrial stock in a market and the amount of that stock that's sold. Well, if we look at the top 5 markets in terms of that percent of stock, and then overlay it with the top ET markets, you see Austin, Dallas, Nashville, and Atlanta right in the top 5. So in terms of looking forward 12 months, those are some really good industrial markets. And Memphis, again, hate to say it too, location. Memphis,
By the way, Michael,
an
Memphis
industrial
is where
market.
Elvis is from, not
That's right.
Nashville.
Thank you very much. So now I can do my Elvis, right?
You
That's
can.
right.
Yeah. Well, that's amazing to know that Atlanta is one of the top cities. That's great. We're right here in Atlanta, and we've certainly seen more increased volume of interest from investors who were maybe just in the core markets are now looking at markets like Atlanta. Well, stay tuned. We'll have more on the industrial market, and including what's going to happen in the industrial real estate market. We might talk about houses, office, everything
You
else.
never know.
Stay tuned. We'll be
Reckless.
right back.
The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL.
Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking about industrial real estate. We have Amy Olsen and Mitch Roschelle with us here in Studio One. And I'd like to ask you guys about cap rates and where they've been in industrial property. Compared to other asset classes, it seems like industrial has gotten pretty popular.
It has gotten very popular from an investor perspective, and the cap rates have trended similarly to other property types, but back in late 2012, the warehouse cap rates actually started to fall below CBD office and strip centers, and within about a year they were well below that, and the trend has continued, and so now they're some of the lowest among the property groups.
Right, I guess except multifamily, right? It's
Right,
always-
exactly. They can't get much lower than multifamily.
Yeah. Oh, come on, 3% cap rate? You can get
Makes
lower than
total
that.
sense, right?
Right.
But think about the fact that industrial is the least expensive asset class to build, and it has a yield that's that low. It's one of the things that makes it really, really compelling to investors because the yield is predictable, albeit low on a risk-adjusted basis with some of its siblings and across other pieces of commercial real estate. But the entry price is relatively low, so it really made it interesting, and it's hard to get. I mean, so there are barriers to entry in every facet of commercial real estate, but it's interesting that demand for the industrial asset class exceeds potentially the supply of new products. So that opens the door for construction and development with a low entry price. So it's really been an interesting, what I'll call virtuous cycle for industrial.
Yeah, and that's a good point. And also it's interesting that, for the larger properties, you also have pretty big tenants. It's not like you have, college students renting them or little small companies, right? You've got some major tenants. Sometimes you've got some single tenant net lease tenants with some strong credit too.
And that opens up the door to a different pool of capital that's interested in single tenant credit leased real estate on a long-term lease. It's a pretty interesting play.
Yeah. Now, one of the things I think our listeners and viewers are always interested in about the cycle, right? Where are we in the cycle? What's going to happen? And I know the cycle can differ for property.
Wait, let me get my crystal ball.
I know, that's what I get.
Right.
The crystal ball is here. The show's crystal ball, right? Let's get it out. And of course, it's going to vary for property classes and locations, but basically, where's industrial in the cycle? How long is this going to last?
Well, we look at 55 markets across the U.S., and if you look at those markets together, in 2015 and 2016, the majority are in the expansion phase, followed by the recovery phase. But going forward to 2017 and 2018, you see more and more entering contraction, which means rental growth is going to slow a little bit, vacancies, may go up a little bit, that kind of thing. But overall, for the next 2 years, things are looking very strong.
Interesting. And despite the strong dollar, the foreign economies, how do those type of things impact industrial real estate?
Look, if you want to talk about capital flows as it relates to industrial, the interesting thing is how industrial's been legitimized in the marketplace. I think it was deemed pre-financial crisis to be the least sexy of all real estate sub-asset classes. It didn't really have an industrial or an institutional following, so it really wasn't legitimized. If you look at the trajectory of cap rates, cap rate compression, and the amount of capital chasing it, all of a sudden it's been legitimized. So the biggest problem with downturns that we've seen in the last several is when the spigot for capital gets cut off, that's when real estate gets choked. But if the spigot's open for industrial because it's been, as I said, legitimized, it's going to be as durable as office may be in the eyes of investors.
Yeah. And I guess there's a lot of foreign investors interested in U.S. real estate, right? And so I guess industrials is strong there with the...
They're as interested in industrial as they are in apartments. Yeah. And on a risk-adjusted basis, or on a price per pound / risk adjusted basis, they're as interested in industrial as they are in apartments, in some cases more. And Amy referenced in the previous segment, emerging trends in real estate. It's been the top pick of investors in our survey for several years now. Those investors include foreign investors.
Okay. And I want you to look into your crystal ball once again and tell us how all this could impact REITs and moving forward, industrial REITs.
So I'll take it to save Amy from having to answer that one. So the specialized REITs, whether they be industrial or any other specialized REITs, really create an opportunity for the retail investor to access that sub-asset class. So to the extent institutional investors have figured out that industrial's hot, and even though it's not sexy, it's still hot, the retail investors are going to follow suit. So it's going to move around with the vagaries of how REITs perform in the market, probably in parity with other REITs. However, retail investors have figured out that it's a cool thing to invest in, and they like the sub-specialization because they get to allocate capital as they see fit in their own portfolio of real estate investments. So crowdfunding, I don't know if it's a question in your next segment. If it is, just kick me under the table and I'll answer it then. But crowdfunding's finding its way into industrial as well.
Is it
Same
really?
thing. Retail investors from around the world want to play in real estate. Well, as I said earlier, if it's got the lowest entry point of anything in real estate, then it makes it even more appealing for crowdfunding.
Well, it'd be interesting to see because it seems like crowdfunding is a little slow to get off the ground. It's not really being used as much as you would think yet. And you think of industrial real estate, like you said, it's not sexy. You know, you look at the brokers around our shop, the industrial brokers, one with the dirty shoes, right? But it is a safe vehicle for investors, isn't it? Whether it's crowdfunding or through a REIT.
And the long-term credit lease aspect of it makes it very interesting, potentially from a crowdfunding perspective, because it's easier to underwrite that credit risk as opposed to a multi-tenant property, even an apartment building, which is the ultimate multi-tenant property.
Yeah. Well, we have to take a short break. When we get back, I want to get your thoughts on if you were going to invest $5 million, $10 million, or $1 million, let's say, $1 million. Where would you go? Where are the opportunities in industrial real estate? If everybody's looking at that asset class, you know, where are some opportunities geographically, size, property types? So stay with us. We'll have that for you next. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back.
Xceligent, the resource professionals like CCIMs, CBRE, JLL, Colliers, and Bull Realty use for market intelligence. Commercial Search is the site to market and find available properties to buy, sell, or lease all over the country. Visit commercialsearch.com.
Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking about industrial real estate. We have Amy Olsen and Mitch Roschelle with us here in Studio One in Atlanta. And one of the things that we talked about before the break is, you know, where are the opportunities for investors or developers in the industrial real estate market right now?
One thing that we really haven't touched on is flex space. And flex space, we talked about in some of the graphics that show the cap rates for warehouse space, but flex space is actually tracking pretty closely in terms of the recovery or the improvement in cap rates. And one of the things that drives demand for flex space, as Mitch always likes to point out, is the home building market. And the home building market and that market is starting to come back. So I think there might be some opportunities going forward in the flex space arena, obviously in warehouse with all the consumption of goods and that kind of thing too. But I think the flex space is something that it's such a smaller segment of the industrial market that maybe we overlook it a little bit.
And that's a good idea because some of the flex space has not been doing that well, right?
Correct.
And what's interesting, I've talked about this on your show before, but almost 5 times more jobs have been created in this country by companies with 49 employees or less, as opposed to companies with 1,000 employees or more. So think about what flex space is. It's part office, it's part warehouse, it can be little offices, it could be little businesses that are starting to create something, whether it be technology, whether it be manufacturing, it could just be a people-driven business. Flex is perfect because the price of doing business in flex space is cheaper than it is in office, especially CBD office and even suburban office. That's what makes it interesting as a play. If you believe that job growth is important to the future of real estate, which I think we all do, and you recognize that those are little companies that are creating jobs, flex is someplace to think about.
Good point. And while I have you here, I got to ask you about the impact of rising interest rates on cap rates. I think a lot of people are concerned that maybe these artificially, some people say low interest rates are causing maybe people to pay too much for properties, concerned that cap rates are going to go up. What do you think moving forward?
So a whole bunch of different random thoughts in no particular order. Number one, the sentiment around commercial real estate investment and the prospects for profitability are as strong as they've been in a long time, maybe as strong as they've been in the last 10 years. Ironically, the sentiment was exactly the same in 2006, but the fundamentals are totally different than they are today, then, right? So we were building new commercial real estate at a rate about 3% of outstanding inventory at the time. We're doing it at around 1%, and that's national. There are markets that are creating no new supply. Demand is rising everywhere as the economy continues to slowly recover, so that demand is not satisfied by supply, so that's a good problem to have. So that's the background. So could the commercial real estate market handle a 50 to 100 basis point rate increase? Absolutely, because we were doing more in commercial real estate development and investment when rates were 400 basis points higher than they are today. It's not artificial. The fundamentals are strong. The economic growth is there. The job growth is there. The retail sales are there. All of the metrics that are important for the real estate economy are actually there. It's just a matter of people looking at low rates and taking advantage of it. The one thing I'll leave you with is when we measure sentiment and emerging trends, we also measure the expectation of rate rises. Everybody in the real estate industry expects rates to rise, and they feel strong about sentiment. So that tells you that they're not fearing interest rate hikes. I personally think that the industry could handle a 100 basis point rise in rates, if not 150, as long as it's gradual. If it happens overnight, shock to the system, but if it's gradual, which I suspect that that's the way the Fed's moving, the real estate industry can handle it.
Yeah, well, that'd be interesting to see, especially with that, the cost of funds and what people can pay for things, and if it decreases some of the demand. But like you said, even if it does cause a slight increase in cap rates, we're also going to have NOI growth. And well, that's all the time we have today. We appreciate you guys coming in and joining us here in Studio One.
Thanks, Michael.
Thank you so much.
Thank you, and we'll Periscope better next time. Right?
We're learning how to Periscope.
All right, and be sure and join us next week. We're going to have an update and an outlook for the REIT market. So until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show.
The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit CREshow.com.